Question 61. You've been provided the following information. We've got daily volatility estimate, decay factor, and most recent market return. Using the exponentially weighted moving average method, what is the new estimate for volatility? So the formula we're going to be using here, we'll walk through these variables. So our volatility standard deviation is going to be our decay factor, which is going to be that lambda variable. And then we're going to multiply that by the most recent daily volatility estimate, which is going to be this right here, and that's going to be squared. And then we're going to add that to 1 minus our decay factor, and then multiply that by the latest market return squared. So that's the u squared. The u variable is going to be market return. And so when we work that through, we're going to get that standard deviation squared is going to equal 0.000525. And then we need to take the square root of that to get our answer. And we get 2.291, which lines up right there with answer C. Question 62. An investor buys a European put option on the shares of Ulu Corp for a strike price of USD 25. Suppose the price of the share falls to $20 at the time of the maturity of the option. So that's going to be a positive for us since we bought a put option. We're going to profit when price falls. If the cost of the put option was $2, then what is the net profit for the investor? So we bought at a strike price of 25 and we gained $5 per share here. So we gained $5, but then we need to take into account that premium. So we're going to have to take $2 off of our profit. So this one's pretty straightforward. Our profit on the put is, our net profit is going to be the profit on the put minus premium paid. So that profit will be 25 minus 20 gives us 5, and then subtract out that premium, $3. Answer C. Question 63. Patricia Rice, FRM, is evaluating the risk management of Bright Technologies. She is asked to categorize the following events into various types of risk. Identify each numbered event as a credit risk, market risk, business risk, operational risk, and legal risk. So we've got these 5 events here, and then we need to put those into the 5 buckets of risk. Number 1, a delayed launch of the latest model of an internet connectivity gadget leads to an inventory pileup of the older product and a USD $1 million write-off of excess inventory. So this is going to be a business risk, and that's because it's related to kind of product and directly related to kind of revenue and profits. We're delaying this launch of the latest model, and that's leading to this bad thing financially for us. So that's going to be a business risk above anything else. So right away, we've got operational risk, so we can go ahead and rule out A. And then for D, we have operational risk 2, so we can rule out D as well. So we're looking at B and C here, and we'll be comparing these down the line. So 2, we can see here we have operational risk for both of these, so let's make sure it makes sense. Insufficient training leads to misuse of the check clearing system. That sounds correct. We want to make sure our training is up to snuff so that operations, like the systems that we're using, are going well and smoothly. C, credit spreads widen following bankruptcies. So we're looking at either credit risk or market risk here. So this one's a little bit tricky since it says credit spreads. We would kind of think that this would be credit risk, but it's actually going to be market risk. And the reason for that is because this isn't necessarily affecting our credit risk in some way. So we're from us being a creditor of something, it doesn't increase the company's personal credit risk of any counterparty or anything like that. But it could lead to some wider kind of market issues. So that's where that's going to fall into 3, market risk. So it looks like we're going to be choosing answer C. Let's make sure that 4 and 5 kind of fit into these 2 buckets. So 4, swap seller does not have the resources required to honor a contract. So this is where it makes it a little easier to kind of understand the credit risk. So we're on the other side of this swap. We have increased credit risk here personally because they're not going to be able to pay us back. And so that is going to be a risk to our company. We're not going to be getting the money we should have from the swap. And then D, credit swaps cannot be netted because they originated in Canada and Sydney. So that definitely sounds like a legal issue since we're kind of dealing with cross-border stuff. So I think we can check those off as good for Form 5 as well and stick with answer C. Question 64. A certain analyst uses the EWMA model with lambda equal to 0.9 to carry out an update of correlation and covariance between the returns of two assets, A and B. The analyst observes that on day n-1, the return on A is 2% and that on B is 3%, and the correlation between A and B is 0.5. In addition, the volatilities of the return on X and Y are 1 and 2% respectively. Estimate the new coefficient of correlation. So our final formula that we're going to need to reference here is the correlation formula, which is going to be equal to the covariance of A and B divided by the standard deviation of A times the standard deviation of B. So these are the three numbers that we need to solve for in order to estimate that new coefficient. So we're going to be taking the new information given in here, and then eventually we'll have these three numbers and be able to plug that in. So starting out, we're going to take a look here. Let me bring all this over. So this is going to be the formula we're going to be using for our updated volatility. So for our updated volatility, we're going to be taking lambda, which is given at 0.9, and then we're going to be multiplying that by our previous standard deviation, which is given at 0.01 for X and 0.02 for Y, sorry. And so we're going to take lambda times the standard deviation of X and then add that to 1 minus the return. So we'll be taking 0.02. So that's going to be plugged in right here. And then we will be able to, sorry, I'm going a little slow on this. So this is what those calculations are going to look like. So we've got that 0.9 multiplied by 0.01, which is going to be that first volatility for A. And then we're going to be adding that to 1 minus the lambda times the return squared. And so that's going to equal 0.00013, and then volatility is going to be the square root of that, which gives us 0.0114. So to be clear, this number is going to get plugged in right down here, new standard deviation of A, and then 0.0212 plugged in right here for B. So that's where those numbers are going to come from. And then to calculate the covariance, the new covariance of A and B, we need to know the previous covariance. So the previous covariance is going to be just kind of this formula rearranged. So it's going to be the correlation multiplied by the current standard deviations. So the previous period covariance is going to be current correlation of 0.5 and then multiplied by those two standard deviations. So 0.01 times 0.02. So our current covariance will be 0.0001, and that's going to be used in calculating this new covariance, which is going to be that lambda figure multiplied by 0.0001 plus 1 minus 0.9 multiplied by 0.02, and then all that multiplied by 0.03, which gives us 0.00015. So then this is going to be what gets plugged into this denominator up here, or numerator right up here. So bringing all that home, we can see where these numbers get plugged in. So we've got this here, gets plugged in right here in that numerator, and then these updated volatilities go right down in the denominator, get multiplied together, and that gives us a new correlation coefficient of 0.62. Which corresponds with answer B. Question 65. Peter Drury, FRM, serves as the Chief Risk Officer at Capital Bank. He recently finalized a comprehensive risk assessment on a series of investments in credit default swaps. According to his estimates, the portfolio had a 1% chance of losing USD 500 million or more over 1 year, a big enough loss to trigger insolvency or attract takeover bids. Based on Drury's assessment, Capital Bank's CEO authorized a large investment in additional swaps. At the end of the first year, the portfolio had lost USD 650 million. The bank was immediately closed down by the regulator, pending a comprehensive audit and review of the bank's investment policies. Which of the following statements is correct? So we've got A, the outcome demonstrates risk management failures because the CRO failed to foresee a move by the regulator. Neither did he attempt to stop the shutdown. I think we can rule that out. Not foreseeing the regulator stepping in isn't necessarily the CRO's failure. I mean, they knew that it would be big enough to trigger insolvency, which I think that kind of implies that there may be some need for a regulator to step in at that point. B, the outcome demonstrates an outright risk management failure because the occurrence of a supposedly extreme event means the probability of such an outcome was poorly estimated. We can rule that out as well. Just because the outcome didn't align with the process doesn't mean that the probability was off. Maybe that 1% chance of outcomes really did happen and they lost more than that amount because that thing did happen. D, the outcome demonstrates risk management failure because the CRO did not eliminate the chance of a financial loss. We can rule that out too. We're not going to be able to ever eliminate chance of financial loss completely. If we do so, that means we're taking on no risk, and so all we would earn is kind of the risk-free rate. On the basis of, so it looks like D should be our answer. Let's make sure it sounds good though. On the basis of the information provided, one cannot conclusively determine whether this was a risk management failure. And that sounds correct. I mean, the CRO gives the CEO all of this information, and then it says the CEO specifically authorized the additional swaps. So we can't really kind of determine whether the CEO took that all into account and was being reckless, or if they kind of just made a calculated bet based on it being such a small chance of losing that money. So we'll go with D. Question 66. Baxter Bank is following the Basic Indicator Approach for calculating the operational risk amount for the year 2016. Some past financial details of the bank are given below. So we've got the years, then we've got net interest income and non-interest income. All amounts are in USD millions. Based on the original Basel Accord, the bank must hold capital for operational risk for 2016 equal to. So the capital for operational risk under Basel is going to be 15%. And that 15% number is going to be gross income, which is going to be both of these two columns added up. And we're going to take the average over those last 3 years. So we'll take the average of these three to get that 2016 number. And so here's what that's going to look like. We'll take average of last 3 years gross income, and then we're going to multiply that by 15%. So we've got 102 plus 25, and then we're adding that to 104 plus 22, and then adding that to 98 plus 21, and then we'll divide that. So we get 124. And then we multiply that by the 15% requirement there to get 18.6, and these are all in millions. So we've got 18 million, 18.6 million. Answer B right there. Question 67. In the run-up to the 2007-2008 financial crisis, Trevor Smith inherited 10 million USD from his grandfather. During the crisis, Smith suffered huge losses in his equity holdings, and he now wants to invest the inheritance with minimal risks. He is considering the following options. So we've got options 1, 2, 3, and 4. We've got deposits at AA rated banks and then one AAA rated bank. Interest rates and then their compounding frequency. Which of these options has the highest monthly compounded interest rate? So what we're going to be doing here, we need to transform all of these different rates into monthly based on what they're at now. So we're at semi-annually, annually, and continuously. Notice for option 1, we're already at monthly, so we won't have to do anything there. So I've got the info down here already, so let's scroll down. So this first formula, this is what we're going to use for the non-continuous compounding options. So for option 1, we don't have to do anything. And then for options 2 and 3, this is what we'll be using. So we're going to have 1 plus R1, which will be our interest rate. So we've got 3.1. And we're going to divide that by 2 since we're compounding semi-annually. And we notice right down here, we're not dividing by 2 since this is going to be compounded annually. not semiannually. And then we're going to have M1 over M2. So we're going to have 1 over 6 here and 1 over 12 here, since we're compounding every 6 months here and every 12 months here. But we want to be compounding every month, since that's what we're looking for our interest rate. And then we subtract 1 at the end and multiply by 12 to get that monthly rate. So we get 3.0802 for option 2, which is so far higher than option 1, and 3.0568 for option 3, which is also lower than option 2. So option 2 looks like our highest rate so far. And then for option 4, it's going to be continuously compounded. So we're going to take Euler's number for that continuous compounding, and then take that to the 3.05 divided by 12, and then subtract out 1, multiply by 12, and when we do that, we get 3.0539. So that number is going to be lower than option 2 as well. So we can confidently go with answer B. Question 68. For which of the following reasons are ratings agencies most usually criticized? A, being too optimistic in the assessment of corporate ratings and too pessimistic in the assessment of sovereign ratings. So we're going to rule this one out, since the critiques are usually that they're too optimistic in both scenarios. So they are usually too optimistic in corporate ratings, but they're also generally too optimistic in sovereign ratings, at least in the criticism. B, failure to align ratings with each other before publishing. Example, one rating agency may downgrade a sovereign rating of the country to speculate grade, while the other can still keep it with investment grade. So this is going to be incorrect as well, and this is why we want to have more than one rating agency, because we want them to be independent and make their own judgments. So we don't want them to all come out and do the same thing. Otherwise, they could just consolidate into one. C, taking too long to change a rating. They are generally very heavily criticized for this, so it looks like C will be our answer. And then D, charging high fees for publishing corporate and sovereign ratings. We can rule that out as well, since on the sovereign side, they do a lot of these for free, since emerging market companies and frontier countries are not going to be paying them for this. Answer C. Question 69. Which of the following best describes the responsibility of the board of directors in an institution's stress testing framework? A, to design detailed stress test methodologies and scenarios used by business units. I think we can rule this out. This is likely going to be more so the executives at the company, maybe somebody like the chief risk officer and some other people under them, who are going to be designing this, since they're going to be more familiar with and understand those different business units and scenarios a lot better than the board might, who's not in the trenches on the day-to-day. B, to ensure that stress testing outcomes are independently validated by external auditors. This is going to be helpful for the risk function, but I don't think this is going to fall under the board of directors jurisdiction here. C, to provide oversight, approve the stress testing framework, and ensure it is integrated into the institution's overall risk management process. That sounds more like our answer, especially when we've got oversight. The main thing the board of directors are going to be doing is advising and providing that advice and overseeing things that are happening versus kind of ensuring outcomes or doing the design themselves. And then D, to manage daily execution. Again, this goes against what we just talked about in C, of stress tests and report deviations to regulators. That day-to-day stuff is going to be run by the companies. Again, the board of directors are there to give advice and provide that oversight. Answer C. Question 70. An investor who buys a put with a strike price of 25 and sells an option with a strike price of 20 is most likely following which of these strategies? So before we look at these answers, let's just talk about this. So we're buying a put at 25, so we want the price to go down, and we're going to profit if the price of the stock goes down below 25. And then we're selling a put with a strike price of 20. So we're putting a floor on what we're going to be able to earn from that to kind of fund this. But at the end of the day, we want the stock price to go down in order to profit here. So let's keep that in mind as we look through these answers. So we've got a bull spread. So if we want the stock price to go down, we're going to be bearish, not bullish. So we can go ahead and rule out bull spread right away. B, a box spread. So a box spread is typically going to combine a bull spread and it's going to combine a bear spread to earn basically a risk-free profit. So you're going to be taking this leg here where you're buying a put with a strike of 25, selling a put as a strike of 20, and then you'd be buying two call options. Then you'd be buying another call option and selling another call option as well. And those positions would basically all offset each other and you'd earn that risk-free rate. So that's not what's being described here. Answer C, butterfly spread. So a butterfly spread is going to be three different options, and it's not going to be aiming to profit from prices dropping like this strategy is. It's going to be aiming for a change in or an increase in volatility in order to profit. So it looks like we're left with bear spread, which is what this describes, and key there, bear, we want the price to go down. So it's helpful to kind of understand that right from the outset. Answer D.